You have a checking account for daily expenses, a high-yield savings account elsewhere, and an investment app. Your money is all over the place. When your cash is scattered across different logins, things slip through the cracks. Transfers get delayed, overdrafts sneak up, and the specific savings goals you set end up stalling out. The natural instinct is to download whichever trending digital banking app promises to fix the mess. But adding another account usually just adds another login. This fragmentation means you are working hard for your money, but losing its actual utility to administrative friction. To fix this, you have to look past the top-line interest rates. You need to choose a structural philosophy for how your money flows. Digital banks generally force you to make a basic choice: internal consolidation versus external aggregation. This flowchart maps your choice based on friction. If you have too many logins or lack visual goals, choose internal consolidation for simplicity. If you are forgetting to save or want higher yields, choose external aggregation. You gain returns but increase overhead. This choice dictates whether you spend your weekend managing your money or actually living your life. Let's look at the first architecture, the visual bucket method, used by banks like Ally. This matrix maps out the options. The bucket strategy requires you to manually configure up to 10 digital sub-accounts within a single savings account. This chart shows that by doing this, you gain immediate visual clarity on distinct goals, like a down payment versus an emergency fund, while still earning a competitive 4% APY on your total balance. However, banks using this method typically have limited external account aggregation. It creates a blind spot for any assets held outside this primary bank. The bucket method is effective at preventing accidental spending on the wrong goals, but it isolates your view of your total wealth. If that isolation is a deal breaker, the second architecture is the comprehensive ecosystem, led by platforms like SoFi and Wealthfront. To make this work, you have to migrate your checking, savings, loans, and investments entirely into their unified platform. This matrix shows the result, a unified money map. You get instant money movement and top-tier interest rates across all your asset classes in one place. You pay for that convenience with platform lock-in. It prevents you from easily utilizing specialized products released by competitors. Ecosystems save time and provide clear dashboard analytics, but they require you to use proprietary products over optimized ones. If managing multiple categories sounds exhausting, there is the third architecture, the frictionless simplifier, like Chime. You use exactly 2 linked accounts, checking and savings, and rely purely on automated roundups. This streamlined setup eliminates decision fatigue entirely. It results in consistent savings without any manual intervention from you. The trade-off is significant. You give up high yields and advanced banking features. You accept lower interest rates as the price for stopping financial paralysis or overdraft behaviors. Finally, there is the hybrid power user strategy. This involves maintaining separate accounts at brick-and-mortar branches, modern digital banks, and distinct brokerages simultaneously. Operating this way requires using third-party tools, like budgeting aggregators or browser isolation software like Send.win, to manage the complex web of logins. This chart shows how the hybrid row achieves the highest return on every dollar. You utilize the best product for every specific need. But the trade-off is a massive increase in administrative overhead and security risks, requiring strict credential management across platforms. The hybrid strategy yields the highest financial return, but it requires you to manage your personal finances like a part-time job. So how do you decide? You have to evaluate based on your personal behavior, not marketing metrics. This chart plots the 2 axes of a successful banking choice: your need for behavioral control versus your tolerance for financial complexity. If you easily feel overwhelmed, stay in the bottom left quadrant and choose the simplifier, like Chime. If you are a visual goal setter who wants a simple structure but manual control, choose the bucket method with Ally in the top left. If you are an optimizer who needs complex tools but wants them to run on autopilot, choose the ecosystem in the bottom right. And if you are chasing the highest yields and are willing to use tools like Send.win to manage the complexity, your path is the hybrid strategy in the top right. When you pick a platform that conflicts with how you naturally handle tasks, the system often falls apart once the initial novelty wears off. The highest interest rate is irrelevant if the platform's friction causes you to avoid logging in. Your financial architecture must survive the reality of a stressful, busy Tuesday morning. It cannot just look good on a spreadsheet. Define your specific point of financial friction before opening your next account. Effective management results in an infrastructure that handles the heavy lifting while you focus elsewhere.